There's a Social Security rule that strips benefits from thousands of retirees every single year. And the people it hits the hardest are not the reckless ones. They are not the ones cheating the system or ignoring the rules. They are the people working 20 hours a week at a grocery store, or doing a little bookkeeping from home, or picking up a few catering shifts on the weekend, trying to stretch a fixed income just far enough to make it through the month. And SSA penalizes them for it anyway. The rule is called the earnings limit. In 2026, that number is $24,480. Cross it by $1 and SSA starts taking back $1 for every $2 you earn above it. Not as a tax, not as a quiet deduction. They withhold your actual checks. The money you were counting on to pay rent, cover prescriptions, buy groceries. It disappears before it ever reaches your bank account. Now, what makes this rule especially dangerous is how invisible it is until it's too late. Most people collecting Social Security have never read a single page of SSA's earnings test policy. They didn't hear about it at the Social Security office. Their neighbor didn't mention it. Their adult children don't know it exists. So they keep working, keep collecting, and assume everything is fine, right up until the letter arrives. That letter is an overpayment notice. It tells you that you received benefits you weren't entitled to, and that SSA is going to take them back. By then, the money's already spent. The damage is already done. This video exists so that letter never lands in your mailbox. Stay right here. Let's start with the core mechanics, because even people who have heard of the earnings limit often have it only half right. And that half understanding is exactly how they end up in trouble. By the time we finish here, you're going to know exactly how this trap works, who it hits, what income actually triggers it, how to calculate whether you're in danger right now, what the most expensive mistakes look like in real life, what SSA does when you go over, how the credit system works, and what you can specifically do before June 10th to protect every dollar you've earned. The Social Security Retirement Earnings Test applies to anyone collecting benefits before full retirement age. In 2026, full retirement age is 67 for people born in 1960 or later. If you were born before 1960, your full retirement age may be slightly lower, 66 in some months, depending on your birth year. If you're under that age and collecting benefits, SSA applies a simple but brutal formula. The annual earnings limit for 2026 is $24,480. Every dollar you earn above that line triggers a $1 withholding for every $2 over the cap. Now, let's put real numbers on that. Say you're earning $30,000 in wages this year. That's $5,520 over the limit. SSA's formula says they withhold half of that overage, $2,760 in total benefits. If your monthly check is $1,200, that's more than 2 full checks gone for the entire year. But here is what most people do not understand about how SSA actually takes that money back. They don't spread it out. They don't shave a small amount from each check every month. SSA withholds entire checks, 1 full month at a time, until the $2,760 is recovered. So you could receive your normal payment in January, and then nothing in February and nothing in March, and a partial check in April before things normalize. 3 months of financial disruption from 1 year of working a little too much. And SSA often estimates your earnings at the start of the year based on what you report. If your actual earnings come in higher than what you projected, say you got extra holiday hours or your side business had a good quarter, SSA recalculates at the end of the year and withholds from future checks to recover the difference. That means the disruption can come months after the year when you actually earned the money. You're already into the next year, living your normal life, and suddenly the checks slow down because of what you earned last spring. That is the trap. And now you understand exactly how it works. Abstract rules are easy to ignore. Real numbers are harder to walk away from. So let's walk through a scenario that plays out thousands of times a year across the country. Meet Barbara. She's 63, lives in Georgia, and claimed Social Security at 62 because she lost her full-time job and needed the income. Her monthly benefit is $1,150. After some months at home, she found a part-time position working the front desk at a medical office. 3 days a week, $16 an hour. That comes out to roughly $29,952 a year. Under the 2026 limit, Barbara is $5,472 over the threshold. SSA's formula, $5,472 divided by 2 equals $2,736 in withheld benefits. Now, $2,736 divided by her monthly benefit of $1,150 means SSA withholds 2 full checks and most of a third. Barbara loses benefits in January, February, and part of March before she sees a single payment restored. Here's the part that is genuinely painful. Barbara took that part-time job specifically because $1,150 a month was not enough. She needed the extra $2,500 a month from work to cover her rent. So now she has both income streams working against each other. The more she earns at work, the less SSA pays. And she never saw it coming because nobody told her the rule existed. Now, here's what Barbara should have done. Before she accepted that job, she should have run the numbers. $29,952 in wages minus $24,480 equals $5,472 over the line. Half of that is $2,736 withheld from SSA. That's the real cost of that job, not just the wages minus the SSA penalty. And once you see it that way, you make a smarter decision about how many hours to work and whether to adjust your hours to stay under the limit. Barbara's situation is not unique. It is the default experience for anyone who claims early and goes back to work without knowing the earnings test exists. And the fix is always the same. Know the numbers before you commit to the hours. Now let's be precise about who this actually applies to, because a lot of people watching this are either overworried about income that doesn't trigger the rule, or underworried about income that absolutely does. The earnings test applies to anyone collecting Social Security retirement benefits before full retirement age. That includes people who claimed at 62, 63, 64, 65, or 66. It also includes certain people receiving survivor benefits or spousal benefits before their own full retirement age. The moment you hit full retirement age, the test ends completely, not gradually, completely. You can earn $200,000 a year after full retirement age, and SSA will not withhold a single dollar of your benefit. The rule simply stops applying. Now, here's the group that gets caught most often. People who are in the year they hit full retirement age. They assume that because they're about to age out of the rule, it no longer applies. But it absolutely does, right up until the month of their birthday. For that group, SSA uses a more generous threshold, $65,160 in 2026, and the withholding rate drops to $1 for every $3 over the cap instead of $1 for every $2, but that threshold still exists. And if you're working significant hours in the early months of the year you hit full retirement age without knowing your exact window, you can still lose benefits, even at the more forgiving rate. So the three groups who need to pay attention are early claimants under full retirement age, people turning full retirement age this year, and anyone receiving spousal or survivor benefits who hasn't yet reached their own full retirement age. If you're in any of those categories and earning wages, this rule applies to you right now. This is where the most expensive mistakes happen, not because people are dishonest, but because they genuinely do not know which income SSA counts toward the earnings test, and which income it ignores entirely. Wages from a job count, net profit from self-employment counts, freelance income, consulting fees, gig economy payments, seasonal work, side business revenue, all of it counts, as long as it's income you earned by working. What does not count? Pension income, Social Security payments themselves, investment dividends, interest income, capital gains, rental income, and withdrawals from retirement accounts like IRAs or 401ks. None of that. SSA doesn't see any of it when applying the earnings test. Now, this distinction changes the picture dramatically for a lot of people. Someone drawing $1,200 a month from a pension, $500 a month from an IRA, and earning $18,000 in part-time wages is sitting well under the $24,480 limit, even though their total annual income from all sources is close to $38,000. Only those wages count. The rest is invisible to the earnings test. Self-employment is the area that causes the most confusion. SSA looks at net profit, revenue minus legitimate business expenses, not gross sales. So a self-employed person with $35,000 in revenue but $14,000 in real business costs has a net income of $21,000 for SSA purposes. That keeps them under the limit, even though their gross income looks higher. But here is the complication. SSA also applies what they call the substantial services test for self-employed people. If you're actively running a business, managing clients, making decisions, showing up consistently, SSA may still count your involvement as work, even if you've structured your net income to look low. You cannot simply create paper deductions to zero out your profit and then operate a full business behind the scenes. SSA looks at both the numbers and the activity. The practical rule is this: before you assume any income is safe, ask yourself whether you earned it by working. If yes, it probably counts. If it came in passively, from a pension, an investment, a rental, a retirement account, it almost certainly doesn't. So if any of this is already hitting close to home, the best thing you can do right now, other than finishing this video, is subscribe to this channel. Because SSA rules change every single year, and the numbers that matter for 2026 will be different in 2027. The people who stay ahead of these changes are the ones who keep every dollar they're owed. Subscribe now. Now let's talk about why this video says watch before June 10th. Because that framing is not accidental, and it's not fake urgency. There's a real reason mid-June is the most important moment of the year for anyone under the earnings limit. Right now, you have 5 full months of 2026 earnings behind you. That means you have enough real data to project where you're going to land by December. This is the window, right now, where you still have time to change the outcome. Here's the math. Divide your year-to-date wages by 5. That gives you your monthly average. Multiply that by 12 and you get your projected annual earnings. If that number is above $24,480, you are on pace to trigger the earnings test. If it's significantly above, say, $28,000 or $30,000, you need to make a decision in the next few weeks, not the next few months. Now, here's why June matters so much compared to, say, October. If you discover in June that you're on pace to go $4,000 over the limit, you have 6 months of runway. You can reduce your hours, you can take a few weeks off, you can talk to your employer about scheduling. 6 months is enough time to bring your annual total back under the threshold if you act now. If you discover the same thing in October, you have 2 months. The math becomes almost impossible to fix. You'd have to dramatically cut your income in November and December, which may not even be feasible depending on your work situation. Most people in that position just accept the loss and move on, which is exactly what SSA is counting on. So June 10th is not a government deadline. It's a decision deadline. The deadline for you to check your numbers while you still have enough year left to do something about it. Pull up your pay stubs, add up your earnings, do the math. This is the week. There is one SSA rule that can genuinely save money for people in their first year of benefits, and almost nobody talks about it outside of SSA's own policy documents. In the first year you receive Social Security, SSA offers what they call the Special Earnings Limit Rule. Instead of only using the annual total, SSA can pay a full benefit for any month in which your earnings fall below the monthly limit. In 2026, now that monthly limit is $2,040 for people under full retirement age for the whole year. Imagine someone who retired from a full-time job in July 2026 and claimed Social Security at the same time. From January through June, they earned $38,000, well above the annual limit. Under a strict annual reading of the rule, they'd appear to owe a significant amount back. But under the first year monthly rule, SSA looks at earnings month by month from the point they started receiving benefits. If that person kept their part-time earnings below $2,040 every month from July through December, SSA pays every check, every single one. The $38,000 earned before they claimed simply doesn't count against them for the purpose of the monthly rule. That is a whopping difference for someone in their first year. It can mean the difference between receiving 6 months of benefits and receiving none. And most people never know to ask about it because it's buried in SSA policy and not mentioned in the standard benefit letters. Now, this rule has limits. It only applies in the first year of claiming. After that, SSA switches permanently to the annual test. And for self-employed people, it also requires that you're not providing substantial services in the business during those months. But for the right person at the right time, this rule is one of the most valuable pieces of information in the entire Social Security system. If you just claim Social Security in 2025 or 2026 and you're still working, ask SSA specifically about the monthly earnings rule for your first year. Don't assume it applies automatically. Confirm it with them directly. Let's talk about what actually happens when someone goes over the limit, because the paperwork side of this process is something most people handle badly, and handling it badly makes everything worse. When SSA determines that you received more benefits than you were entitled to, they mail an overpayment notice. The letter states the amount owed, the period it covers, and your options for resolving it. It typically gives you 30 days to respond and 60 days to file an appeal if you disagree. Now, here is what most people do when that letter arrives. They panic, they call their daughter, they worry about it for a week. And then they either ignore it, which is the worst possible move, or they start sending money immediately without reading the letter carefully. Neither response is right. The first thing to do is read every line of that notice. Check the dates they are covering, check the earnings figure SSA used, check their math. SSA makes errors. They may have used the wrong income figure, the wrong period, or applied the formula incorrectly. If anything looks off, you have the right to request reconsideration within 60 days. File that request in writing. If the overpayment amount is correct, but you genuinely cannot afford to pay it back, you can apply for a waiver. SSA grants waivers in 2 situations: when the overpayment was not your fault, and when repaying it would cause financial hardship. If both of those conditions apply, SSA can forgive the debt entirely. You do not have to pay it back at all. And if SSA denies the waiver, you can appeal that decision too. Most people never get to this point because they assume the letter is final and the amount is non-negotiable. It's not. The appeals process exists precisely because SSA acknowledges the system makes errors and that some overpayments cause genuine hardship. The bottom line, never ignore an overpayment notice, but never assume it's the last word either. Read it, check it, and respond within the deadlines. Now here is the part of this story that should genuinely give you some relief, if you understand it correctly. When SSA withholds benefits because you went over the earnings limit, that money is not gone permanently. Once you reach full retirement age, SSA recalculates your monthly benefit to give you credit for every month your payment was withheld. The mechanism works like this. SSA treats each withheld month as if you had delayed claiming by 1 month. And because delayed claiming increases your monthly benefit by a fraction of a percent for each month past your earliest eligibility, your payment goes up permanently at full retirement age to reflect those withheld months. So if SSA withheld 4 full months of benefits from you over the course of your pre-FRA years, your monthly check at full retirement age increases as though you had waited 4 extra months to claim. For someone with a $1,200 benefit, that might translate to an extra $30 or $40 a month for the rest of their life. Not dramatic, but real and permanent. Now, whether this makes you whole depends entirely on how long you live. If you live into your mid-80s, the higher monthly payment over many years adds up and can exceed the total amount withheld. If you don't, the math doesn't fully recover. That is the honest reality. But here's the point that matters most for how you should think about this rule. Losing benefits to the earnings limit is painful. It is disruptive. It creates real short-term hardship. But it is not the same as losing that money into a void. Part of it comes back in the form of higher monthly payments for the rest of your life. We have to understand this and position ourselves accordingly so that if the trap does catch us, we're not making additional panicked decisions on top of the first mistake. So here's where everything lands. Here's what you actually do. Not someday. This week. Move 1. Calculate your year-to-date earnings. Pull out your pay stubs or bank deposits from January through May. Add up only wages and self-employment net income. Leave out pensions, IRAs withdrawals, investment income. Get a clean number. Move 2. Project your annual total. Divide your year-to-date wages by 5. That's your monthly average. Multiply by 12. That is your projected annual earnings from work. If the number is above $24,480, you are heading toward the trap. Move 3. Calculate your projected penalty. Take your projected annual earnings, subtract $24,480, divide the result by 2. That is approximately how much SSA will withhold from your benefits this year. If that number is more than 1 month's check, you need to act. Move 4. Decide on your response. You have real options here. You can reduce your hours now to bring the annual total back under the limit. You can contact SSA and voluntarily suspend your benefits. That stops the checks, but prevents an overpayment problem later. If you claimed in the last 12 months and this is your first year, ask specifically about the monthly earnings rule. And if you're several years from full retirement age and the situation is getting complicated, consider speaking with a benefits counselor before making any major changes. Move 5. Schedule a 6-month check-in. Set a reminder for December 1st to review your year-end earnings. Even if you bring your monthly average down now, check again in December to confirm you actually stayed under the line. That second check is what catches people who adjusted in June, but then picked up extra hours in the fall without realizing the cumulative damage. None of these steps require a lawyer or a financial advisor. They require 20 minutes with your pay records and a calculator. That is the difference between protecting your benefits and receiving an overpayment letter in February. Now, the earnings limit is one of the most consequential rules in Social Security, and it's one of the least talked about. The people who get hurt by it are not careless. They are the people who worked their whole lives, paid into this system for 30 or 40 years. An assumed retirement would be straightforward, and the system made it complicated without telling them. That is why knowing this stuff matters, not as a technicality, as real protection for real income that real people depend on. So, are you currently collecting Social Security and still working? Did you know about the $24,480 limit before today? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.